Hi everyone, this is Brother Willis. I hope you're having a great weekend. This week we're going to talk about the cost of capital, which is a very important concept in finance. The cost of capital is the required rate of return that must be earned on investment projects if the project is to increase shareholder wealth. So who determines what the cost of capital is, the investor or the company? Well, it's always the investor. For example, have you ever applied for a mortgage and told the mortgage company, who is the investor, to give you a mortgage for 2%? No, you apply for a mortgage and then ask the lender what rate they will give you. The required return for the investor becomes the cost of capital to the company, but it is the same number. Remember that capital is never free. The cost of capital is also known as the required rate of return, the hurdle rate, and the discount rate. Those are basically the same thing. Sometimes companies will add a premium to the cost of capital based on the project, and they'll call that the hurdle rate. But generally, these are the same term. So the capital structure for a company is defined as its assets equal its liabilities plus equity. Debt is other people's money. Examples of debt: bonds and notes payable. Equity is the shareholders' money. Examples of equity are common stock, preferred stock, and retained earnings. Retained earnings are simply just profits that have been reinvested into the company. The goal of capital structure is to distribute the claims between debt and equity in a way that will maximize value for the shareholders. So here are some characteristics of debt. It does have a claim on assets and income. There's always the contractual agreement. Occasionally it's convertible to common stock at the lender's discretion. There is always a fixed maturity date. It may be 30 years out, like with a mortgage, but it always matures. Debt holders can force a firm into bankruptcy if there is a default. They don't have voting power. They do not share in residual interest in a firm. That means they don't get capital appreciation. If the stock price goes up, they don't participate in that. It can be senior versus subordinated. Senior debt is like your mortgage. Subordinated debt would be your home equity line of credit. Senior debt is always paid first. It also can have positive and negative covenants. Positive covenants are things the company must do. Negative covenants, things they cannot do. Examples of positive covenants are maintaining a certain level of profitability, making sure employees are paid, making sure taxes are paid timely. Negative covenants, things that a company can't do, or like sell the company, sell some assets, take on additional liabilities without the approval of the lenders. Preferred stock is equity, but it kind of acts like debt because you get like a certain rate of return. It can have multiple classes. It has a claim on assets and income. It has cumulative dividends, which means all preferred shareholder dividends must be current for all years before any dividends can be paid to common shareholders. There are some protective provisions if the dividends are not paid, so sometimes they're given voting rights. They can convert it to common stock. There is no maturity date with preferred stock. They cannot force a firm into bankruptcy, and they don't get residual interest, the stock price appreciation. Common stock, these are the big guys. Collectively, they represent 100% ownership in the corporation. There is a par value that's usually like an arbitrary assigned value of $1. It has authorized versus issued. Authorized is how many shares they can issue. Issued is how many they actually have. It represents ownership. There's no maturity date. It can have multiple classes. It exists as long as the firm does. It has residual claim on assets and income. They vote on all corporate matters, major matters. And in the event of a bankruptcy, they can't exercise their claim on assets until everybody else has been paid, because they are the owners, so they carry the most risk, and because of that, common shareholders typically require the highest rate of return. So here is the capital structure of some popular companies. So you can see the average of these 6 companies is 69% debt and 31% equity. Notice that the combination of debt and equity always adds up to 100% of the assets. So this tells you kind of how they have financed their assets. So generally, large publicly traded companies have a preference towards debt. So you'll find most large publicly traded companies have a debt ratio between 60 and 70%. Some are outside of that. The reason that there's a preference towards debt is because companies try to use other people's money as much as they can, because that way they can provide more return to the shareholders than if they use the shareholders' money. So there's a downside to that. If you look at Ford, 87% debt ratio, if there's a recession and sales decline, they could have difficulty making their debt payments, which could force them into bankruptcy. So if you look down at Marriott and you see that their debt ratio looks way out of whack, that's a little misleading, and that's because what they have done is repurchase shares from the market called treasury stock. And that's actually a method to increase shareholder wealth, because those shares that they repurchase from the market are no longer outstanding. So the remaining shareholders now have a bigger piece of the pie, a bigger share of the dividends, of the profits, stock price appreciation, and so forth. So these are ways of calculating the cost of capital. For debt, you take the yield to maturity multiplied times 1 minus the tax rate. The reason that we make the tax adjustment is because interest on debt is tax deductible. Preferred stock is simply the dividend divided by the price, and then common stock divided by the price plus the growth rate. Now you may have seen, instead of cash, using dividend. I don't like using that for common stock because companies usually don't pay out all their profits in dividends, so I don't want to exclude the value created from profits or cash flow that hasn't been paid out in a dividend. There are also more sophisticated methods for calculating the required return for common stock, but that would be more what you would see in an advanced course. So here's the weighted average cost of capital, which now you know how to calculate the cost of capital of debt, preferred, and common. You can get the company's weighted average cost of capital. The reason we need to do this is because the company has financing sources for more than just one. They don't have 100% debt or 100% preferred stock, for example. So in this example, Capital Company has a capital structure of 60% debt, 10% preferred stock, and 30% common stock. Note those all add up to 100%. The before tax cost of debt is 10%, and then the cost of preferred stock is 15%, and the cost of common stock 20%. But because interest is tax deductible, we have to calculate the after-tax cost of debt. So we do that by taking 10 multiplied by 1 minus the tax rate of 40%. So 10% times 40% or 60% would be 6%. Notice that the after-tax cost of preferred and common is the same, and that is because dividends are not tax deductible. So now we just take 6% times 60%, that's 3.6. 15 times 10 is 1.5. 20 times 30 is 6. We add all those together, and that gives us a weighted average cost of capital of 11.1%. So it's that simple. So good luck this week. If you have any questions, let me know. Thanks.